Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So there are two times where people start talking about the stock market so much, and that's when the stocks are really up and companies like Nvidia and so on are doing absolutely amazing. Crypto is doing really wonderful. Or when the stock market is down so much, people start panicking, start talking about selling everything and so on. And right now we are quite fearful. Okay, a lot of people are now basically saying, yeah, the stock market is doomed and gloom, and nobody should be buying stocks right now. Everybody should be basically selling their stocks, and they have, of course, a reason why they're saying this, and it's because the S&P 500 is down 4%. Now, if you think about it, last year we were up 20 something percent. A year before we were up 20 something percent. So for people to start panicking because the stock market is down 4% just year to date, which is basically since January, we're basically beginning of like midway through March right now, and it's absolutely ridiculous. And this is why I just want to talk about a few really important things today. And basically everyone is now starting talking about the R word, basically recession. And recession is something that everyone more or less, especially in the US, is talking about right now. Okay, you got basically all this type of headlines that are saying potentially we are heading towards a recession, and is almost inevitable. It's going to happen. Okay, and what I want to do today is share with you guys 5 companies, okay, that potentially 7 that are recession-proof companies, if you like. So Ganlog is basically one of the guys, basically CNBC always interview, and he's apparently one of the gurus when it comes to the stock market. And one of the things I was watching his basically speech yesterday, one of the things that he basically said is, he says, I believe that investors should have already upgraded their portfolios. And then he continues to talk about here, I do think the chance of recession is higher than most people believe. I actually think it is higher, more than 50% coming in the next few quarters. And that's interesting. So if a recession happens, what does that mean for us, and what type of stocks will do absolutely amazing for, or basically be the overall S&P 500? And that's what I want to focus on today. I don't want to focus on the doom and gloom. I just want to think about, okay, what type of basically stocks should we own if basically this type of, like, if recession happens. And of course, you don't want to change your entire portfolio, but you just want to be mindful of some of the companies that will do well or have done well previously. I'm going to share with you guys 5 companies that are dividend-paying companies that have excellent credit rating. They done better than the S&P 500 during the last recession. Valuation seems basically reasonable right now. And so yeah, I want to share with these guys and with these basically 5 stocks today. And if we still have a little bit more time in the video left, I don't want to make it longer. I might give you another 3 or so companies. So first of all, what sectors do well? Okay, there's defense sort of stocks do tend to do well when basically there's a recession. And these companies are like, for example, consumer staples. We've got healthcare, basically utilities, stuff basically that people need. Okay, when recession happens, remember, nobody's going to go to Nike or Home Depot and companies like that and buy products that they don't really need. They more focused on basically buy the essentials, and those include companies that sell healthcare companies, because if you're not well enough, of course you're going to buy these these drugs that you need. In terms of consumer staples, again, it's another thing, because you need to, of course, live, right? And then utilities, you need your electricities and all of these things. So the things that companies that do well are these types of sectors, and some I'm going to include into today's video some also technology companies that have actually done well through basically in the last recession. And the first company we're going to look at today is Novo Nordisk. This company is basically trading slightly lower than, so might be undervalued at the moment. It's another healthcare company, 99% dividend safety, AA- when it comes to credit rating, so you don't have to worry about these companies basically debt levels and so on. They increased that dividend. Basically the latest increase was almost 19%, and if we click this, you will see the 19%, but the last 5 years they've actually increased of 22%. So how did they do in the last recession? In terms of sales wise, they actually had a positive, okay, 6% which was above average growth for in basically 2007 to 2009. Now, recession return, this company was basically negative 27. But just remember the S&P 500 during that period was actually negative 55%. Can you imagine right now we're talking about 1%? Can you imagine having for over 3-year period, okay, negative 55%? And this is why newer investors are not going to like this, because if you are just buying stocks because you think they're going to go to the moon next month, it cannot, it can happen, but also it can be the opposite. You might have 3-year period of basically literally negative 55% in the S&P 500, which means basically every single stock that you own in your portfolio that's part of the S&P 500 is going to go down a lot. And that's why we need to be careful when we buy any stocks, and you're buying stocks that you know are going to do well in the long run, and you don't panic sell. So this company has done better than the S&P 500 in the last recession. Now, in terms of dividend, they have increased that dividend for 28 years. This is what you'll get for every share of this company that you own. And in terms of valuations, it seems basically undervalued. If you look at the 5-year average, so this line here, okay, this basically colored line, that blue kind of line, is basically the dividend. So that's basically the line the company should be trading in to be like a fair valued, so on. Anything below that means it's undervalued, above is overvalued. So that's the line it should be basically, okay. But right now, over the last whatever years, you can see it's been overvalued so much to the point where it was hitting about $150 per share at one point, and right now that's below that basically where it has been over the last 5 years. And if you look at the if you use the dividend yield basically theory here, you can see $1.41 is the average for the last 5 years, and right now is over $2, basically 2%. Sorry, 1.4% to right now 2%, over 2%. So that means basically the company is undervalued at the moment, and the 5-year average basically for this company for the PE for basically has been over 30, and right now we're looking about just below 20, which is really good. Now overall, the company is doing well in terms of the payout ratio for basically the dividend that they pay is about 40%. Right now, free cash flow payout ratio is looking about 58%, so it's actually declining. Now, earnings per share is growing every single year since 2015, as you can see, basically nicely growing. Free cash flow margin basically per share is also heading the right direction. And when we look at the shares outstanding, it's declining. Total sales is basically growing year after year, which is really good to see. Return on invested capital, we're looking at about 81%. Return on invested, equity, return on invested capital, we're looking at about 56%, probably one of the best. And this basically is what they expected, basically about 8%, but right now 56%. Operating margins, which is heading the right direction, to free cash flow margin about 24%. And basically when it comes to debt levels, almost non-existent, which is really good to see. So looking at Seeking Alpha quickly, you can see a year to date is down about 10%. Earnings expectations moving forward for this company, we're looking at about 26%, 25%. And so on when it comes to EPS. When it comes to revenue, we're looking at about 7%, 4%, and then 1% or 2% for the following couple of years. So really great company, nothing to worry about. And you can just buy this a company like this and hold it without having to worry about recessions and so on. Of course, only Allah knows what's going to happen in the next recession, if it happens, and how much the stock market will go down. But this gives us at least an idea. It's not going to tell us exactly what's going to happen, but it will give us at least an idea. All right, so the next one is one that actually is one of my favorite companies out there, and that's Mastercard. Mastercard is basically a Sharia compliant company because they do not deal with the riba side of things. They actually are a technology company. They deal with basically making that transaction happen from the person who's selling to the person who's actually buying the product and so on. They have an excellent dividend, basically safety, very safe right now, 99%, looks reasonable right now. The latest growth, basically dividend growth, was about 15%, and as you can see, A+ ratings when it comes out, which is basically strong. If we click this, you will see that that was the latest increase, and the latest last 5 years we're looking at about almost 15%, which is absolutely amazing. Last 10 years we're looking at about almost a 19%, which is wonderful to see. And guess what? Basically the sales when it comes to the last recession actually grew about 2%, which is really good. Now in terms of the recession return, it was negative 12%, but again in comparison to negative 55%, that was absolutely wonderful to see. And again, this is probably one of the companies that has a product that everyone uses on daily basis, despite whether you are basically when there's a recession or not. So 13 years of increase in that dividend, $3 and plus is what you'll get, and right now it looks reasonable. Okay, and if you look at that line again, you can see it's right in the middle of that line right now. That's why basically that's the reason why we're saying it looks reasonable. And as you can see, basically it's almost identical to the way it has been over the last 5 years, and almost identical to where it has been over the last 5 years with regards to PE side of things. And earnings per share is only 20%, so they're spending about 20% of their net income to pay out as a dividend. Free cash flow payout ratio is also 19%, so 19, which is really good. Earnings per share is growing, heading the right direction. Free cash flow per share wonderfully heading the right direction again. When it comes to shares outstanding, as you can see, is actually declining. Total sales is heading the right direction. Return on equity 191%. Return on invested capital 64%. By far one of the best companies out there. Operating margins of 58%. Free cash flow margin of 48%. Absolutely amazing. Debt levels almost non-existent. Again, another wonderful business. Year to date, this stock is almost flat, 1.5%, so nothing basically to worry about in terms of earnings expectations. Moving forward, you can see basically EPS about 9%, 17% again. And when it comes to revenue side of things, you can see about 12%, another 12.5%, another 12%. Basically, there's a lot of analysts looking at this company, so absolutely wonderful, nothing to worry about. Again, another great company. The next company we're looking at today is Abbott Laboratories. This is a pharmaceutical company, 99% very basically safe when it comes to that dividend side of things. 1.8 is what you'll get. Looks reasonably valued right now. 7.3 when it comes to the latest increase. AA minus basically when it comes to the credit rating, very strong. Okay, if we click this, you will see that 7% right now, 11% based the last 5 years. About last 20 years, about 4%, just slightly slow. But when it comes to recession side of things, recession sales grew about almost 4% when the rest of the basically companies declined. And when you look at the recession return, only 13, basically negative 13% in comparison to that negative 55%. Now, if we look at the basic dividend growth streak for 53 years, so this is a dividend king, you get $2.36 for every share of that company that you own. And right now it looks reasonable because it is right in that middle lane there. And as you can see, is 1.8 and 1.88 basically with the last 5 years when it comes to dividend yield side of things. And when you look at the historic values for the last 5 years for PE for ratio, 5-year average basically 24. Right now is about 24. Now looking at the payout ratio, 48%, so it is declining, which is nice to see. Free cash flow payout ratio is also heading in the right direction. Earnings per share, where you can see it's been going basically almost a flat last couple of years, but it has jumped in, expected to jump next 12 months. Free cash flow per share is also heading the right direction. Now looking at the shares outstanding, it has basically haven't bought any of their shares over the last basically 3 years, but that's absolutely fine. At least they're not diluting your shares. And total sales, it's basically expected to more or less to stay the same for next year. Return on equity 31%, return on invested capital of 12%, operating margins of 18%, and free cash flow margin of 15%. And when you look at the basic debt levels, is almost non-existent, which is nice to see for this company. Now looking at Seeking Alpha, as you can see, year to date is actually up about 11%, so it's done really well basically, while the S&P 500 is down about 4%. Now looking at the earnings expectations, we can see 10%, another 10%, another 10%, and then 5%, 7% for the next basically 3 years. So it's actually expected to do well on basically next 3-4 years, inshallah. Right, we've got two more companies. Next one is Procter Gamble. It's a consumer staples company. As you can see, very safe when it comes to that dividend, 99%. AA minus is basically credit rating, very strong. 2.4 dividend yield right now, looks reasonable. 7% growth latest. And if we click that, you can see basically almost 6% over the last 5 years. Last 20 years, about 7%, which is really nice to see. And when it comes to recession sales, basically that decline about 9%. Okay, so that's average growth during basically that time. and the recession return was about 36%, a negative 36% in comparison to that 55%. Now 68 years of increase in that dividend. So despite that recession, they still continue basically increasing that dividend. You just get over $4 for every share of this company that you own, and as you can see, it's trading within that line here. And as you can see here, we've got 2.44% in terms of the last 5 years. 2.42 is where it is right now, and P is more or less the same. Now the payout ratio, it has declined, which is nice to see. Free cash flow payout ratio is also heading the right direction. The earnings per share is heading the right direction. Free cash flow, again, is almost exactly the same way. And when we look at the shares outstanding, they are buying back their own shares. Basically 2023 they bought it back, 2024, and it stayed the same. Basically total sales is heading the right direction, which is absolutely amazing to see for this company. Return on equity, we're looking about 31%. Return on invested capital of 23%. Operating margins 25%. Free cash flow margin of 19%. And debt levels is very, very low for this company. So another great company, but really nothing to worry about. Year to date is flat. Earnings expectations, if we look at this one, you can see 5%, 6%, 7%, and that's what you expect from this company. Really, that 5 to 10% every single year. And basically, when it comes to revenue side of it, that's what you also expect. Nothing really to worry about. Before I start and then talk about this company, also what I would do if I were you, I might not have enough time to do that, but what I would do if I were you, actually look at the basically the total returns for these companies for the last 20 basically years or 10 years or so, and you will see that they have actually, growing the revenues, growing basically total return to shareholders, includes price appreciation as well as dividends. So some of these companies have done absolutely amazing. And the next one we're looking at today, and the last one, is Qualcomm. Again, another basically tech company. So we've already seen Mastercard. We're looking at Qualcomm right now, 80% safety when it comes to that dividend yield of 2.2. Looks reasonable right now. 4%, 5% almost when it comes to the dividend growth, which is March 2025, and A rated when it comes to that credit rating. And if we click this, as you can see here, we've got about almost 6% over the last 5 years, 15% over the last basically 20 years, and recession return was negative almost 7%. That was above average, and negative 21% when it comes to recession return. Now looking at the dividend streak of 21 years, so another 4 years this company will become a dividend aristocrat. Basically you got $3.56 for every share of this company that you own. And if we look at that line, you can see it's within that line right now. It's slightly getting lower, so it looks reasonable, but I think it probably be, if it goes down another 2-3%, it will become undervalued. As you can see here, the average was basically 2%. Right now it's about 2.2%. And EPS is actually slightly lower. If you look in the forward PE right now, not EPS, forward PE 15, and right now we're looking about almost to 14. Now in terms of the earnings per share, earnings payout ratio, 31%, and free cash flow payout ratio 30%. Earnings per share is actually growing in the right direction. Free cash flow basically is heading the right direction. And then we've got shares outstanding is declining, which is quite nice, but they haven't actually bought any shares for the last 3 years. Total sales is actually going the right direction. Return on basically on equity of 42%, return on invested capital of 26%, operating margin of 27%, and free cash flow margin of 32%. Now debt levels are almost non-existent, which is really nice to see as well. And looking at this company, year to date is actually up about 2%, which is decent. When it comes to earnings expectations, we've got 14%, 5%, and then almost a flat in 2027. And then of course we're looking at revenue side of things, about 11%, 4%, and about 2%. Now that's the 5 companies I wanted to share with you guys today. Now there are other companies that I would actually look at if you were interested, and that is Intuit. Okay, there's one that I want to share with you guys before we stop the video. So one is Intuit, this one basically Comfort Systems, which I'm going to go over very quickly, and the other one is J&J, so you can do a little bit more research. This one is done really well. Basically right now you can see about 14% increases recently. If we look at that for the last 5 years, 24%. The last 10 years we're looking at about 18%. And Recession-Proof basically is done about negative 17%, so that's below average growth at that time. And also recession side of things is actually, it's done relatively okay in comparison to the S&P 500, but 12 years of increase in that dividend. Now if you look at the basically currently, it looks basically reasonably valued because it is It was way overvalued. It has come down quite a bit, so it's in line with basically where it has been over the last whatever years. As you can see here, it's slightly below that, and the 5-year average is actually slightly below the when it comes to forward PE side of things. And looking at the earnings per share, earnings payout ratio, just 9%, which is really, really good. Same goes for free cash flow side of things. Earnings per share is growing. Free cash flow basically per share is also heading the right direction. They're buying back their own shares. Sales is heading the right direction. Return on equity 35%. Return on investment 37%. Operating margins of 11%. Free cash flow margins basically also heading the right direction. Almost non-existent when it comes to debt levels. Where this company shines really is the earnings expectations moving forward. 25% in 2025, 10% a year after that, and then we've got 10% basically revenue growth expected this year, and about 7% after that, and then 8% after that. So yeah, that's basically the 5 companies I wanted to share with you guys, but also a bonus stock. Like I said, J&J and Intuit is the other two the two companies that you potentially might want to check out. And again, anything can happen. Recession can happen. It might not even happen, but at least you know what to do in terms of kind of protecting your portfolio. If you're buying stocks in the next few weeks, maybe these are some of the companies that you should be looking at if you are worried about basically a recession. But what am I doing? Okay, I'm just doing exactly what I have been doing and just buying high quality companies, hold them for a very long time. I do believe my portfolio is slightly balanced because I do have some consumer, like some of the companies we talked about today, I do own in this portfolio. Companies like Union Pacific and so on have done overall well over the last whatever years. I do own some, is basically balanced portfolio. The only things that I don't own is like utilities and so on, but I do own some energy companies, we do own some REITs, and we do own some of the Procter Gambles and so on. So inshallah we'll see what happens, but I'm gonna hold on to my stocks. I'm gonna keep buying. I've just added today £500, which I will be adding to the portfolio. Inshallah we'll be doing some buys today, and then I'll share that with the community. So if you haven't joined us at the Patreon account, please do so, where I share a lot of the buys and sells, family portfolios, and I've updated recently the monthly undervalued stocks. There's about 25 companies on that list that you could actually potentially buy based on valuation from Morningstar and Seeking Alpha. Anyway, have a wonderful day. Assalamu Alaikum.